Why don't we kick it off, buddy? It's good to see you. Hello, everyone, and thank you so much for joining us. My name is Ron Quaranta, chair of the Wall Street Blockchain Alliance. WSBA is very proud to offer our latest webinar from member firm Lukka, entitled Tokenization Beyond the Wrapper: What Changes Operationally When Assets Move on Chain. Before we begin, a bit of housekeeping for today's session. Please keep in mind this event is provided for general informational and educational purposes only. It's not intended to constitute investment, legal, tax, or accounting advice, or any sort of regulatory or legislative policy outcomes. Any views or opinions expressed during this webinar are those of the participants, may not necessarily reflect the views of the Wall Street Blockchain Alliance or our member firms. This webinar is being recorded. All attendees, at least will be in a listen-only mode. We encourage everyone to submit their questions to our presenter using the Zoom Q&A function, and we will absolutely leave time at the end of the session. Dan, it is good to see you. Whilst I sort out all of the problems here, I'm going to give you a moment to introduce yourself to the group.
Yeah, sure, Ron. Thanks for having me today. Hello, everybody. I'll just introduce myself really quick. My name is Dan Husher. I'm the Chief Operating Officer and Head of Product at Lukka. And so I've been with the organization now for going on 5.5 years. And so I was originally brought on to build out Lukka's data and analytics business. Primarily, we were a software provider at the time, back in 2021. But I come from a traditional finance background. So prior to joining Lukka, I spent 16 years at a company called IHS Markit. That company is now part of a company called S&P Global. But essentially, I've spent my entire career in a variety of different pricing and reference data roles in traditional finance, and brought a lot of those same kind of skill sets over to Lukka to build out similar products for digital assets. And so, spent 16 years at Market before joining Lukka. And, prior to that, I've spent some time in the United States Army in the early 2000s.
Dan, it's good to see you, buddy. And for everyone in the audience, again, Dan's got a lot to cover here. If you've got questions, please put them in the Q&A. We'll address them a bit later. Dan, as multiple pages show up, I might have to boot them into the attendee room. So hopefully that's okay. Dan, This webinar couldn't come at a better time in my mind. For those of us who've been involved in crypto assets and digital assets and blockchain, tokenization really is front and center in the conversations, particularly in global financial markets. And Dan, what I've found, and I'd love your perspectives on this, when you and I looking at the questions and doing a little bit of prep, a lot of organizations still look at tokenization as, well, I'm just going to place Ron Q Corp on a blockchain. I don't really need to change anything else. Dan, you and I coming out of the worlds we come out of know there's a lot more than just, hey, I've issued an asset. There's identity, valuation, tracking. You're going to be talking about all of these things a bit later on. What actually changes operationally when firms begin to tokenize?
Yeah, it's actually quite a bit, and I think as people continue down their tokenization paths and getting into digital assets, they kind of get into some of these and uncover them. But the first thing that comes to mind is really settlement, right? And so in traditional financial markets, these occur on T+1, T+2 cycles, right? In digital assets and blockchain, your 24/7, 365 settlement, right? And so what does that look like for reconciliation processes? What does that look like for risk processes? These things have traditionally been built for overnight batch cycles, so to speak, right? And so there's not always a clean kind of mapping to kind of the rails back to traditional finance. So that's probably one of the areas, definitely. The second one would be the custody model. Also changes as well. So you have this thing to manage your keys in wallet management, right? And so this is introducing a new control layer, alongside traditional custodian relationships, right? And also risk as well, because you need to manage, potentially some of these keys depending on where and how you're custodying these assets. We're actually starting to see, and this is more, fairly recent, duality in record keeping, right? And so now we're seeing a lot of companies maintain basically an on-chain and an off-chain kind of record, and these things actually need to start, to reconcile. And so, if we're being pragmatic about it, reality is the systems that have been embedded in banks and other traditional financial institutions, they've been in there for 30, 40 years. They're just not going to go away, for the foreseeable future, if ever, right? So reality is they need to talk to each other. Asset location is also starting to become something that our customers are starting to pay attention to, right? And so your kind of your traditional ISIN or your CUSIP style identifier that underpins traditional financial security identifications has a new wrinkle in digital asset, because a tokenization could occur on multiple blockchains. And so is this stock that's been tokenized on the Ethereum network versus Solana are two distinct assets, right? And so your systems need to understand that they're two distinct assets, right? That could lead to some problems downstream, when risk reporting and rolling up positions and things of that nature. So you really got to think about that as well. Another area would be pricing and valuation. So this is actually something that our company, have thought a lot about. You now have this world of multiple venues, 24/7 trading, right? And so like, how do you start to make sense of kind of all of the data, the quality of the exchanges, where this is trading, and then actually create an evaluation methodology, right? And so in traditional finance, particularly equities, it's generally accepted where the principal market is, right? And so the close price is really never refuted. And then finally, just to kind of wrap it up, I would say AML and KYC as well, right? And so the posture needs to change in your compliance departments. If you think about wallet addresses, they aren't automatically tied to verified identities, right? So transaction monitoring, it has to extend to on-chain activity, not just when you're onboarding the legal entity, right? And so, yeah, that's, those are some of the areas that we're seeing quite a bit from our customers.
Dan, I want to rip up the script on you a little bit, and I'd love to dive into a couple of things. And again, coming out of the worlds that you and I know, particularly financial markets, earlier on in your answer, you mentioned custody, and I am still fairly surprised that I see institutions who don't understand the custody challenges in a tokenized or broadly digital asset world. There's no easy way to, if you and I were trading equities, for example, there is this legal and regulatory concept of qualified custodians. Why is the custody challenge different for tokenization to financial institutions?
Yeah, so in digital assets, right, there's a variety of different ways that you can custody an asset, right? And some, I wouldn't say there's a right or wrong answer, quite frankly. I think it's more of a spectrum of different risks that you're willing to accept. And by all means, you can certainly use third-party custodians as well, and they can handle this for you. A lot of think the ETFs, for instance, right? At least in the United States, from where I'm aware, they'll use like a third-party custodian that can handle some of this. And there's others that prefer to do it in-house, right? And so what that means is you need to understand managing your keys and custodying the assets. And also there's AML and KYC things, right, that go along with that as well, of where you're receiving funds from. And all of these things are quite frankly novel, right, in digital assets.
Dan, thanks. I appreciate it. And again, for everyone in the audience, thank you so much for joining us. If you've got questions, please start queuing them up. We've got a lot to cover. Dan, one of the questions that crosses my desk a lot when I talk to institutions across the financial landscape is evaluating tokenization initiatives broadly. And when we look at the operational challenges there, what surprises them most when they look into tokenization?
Yeah, I'm probably dating myself, but I did mention kind of my background, right? And it was Donald Rumsfeld, right? You have your known knowns, your known unknowns, and your unknown unknowns, right? So
we're going way back, buddy.
Yeah, I'm dating myself, all the gray hairs I have, right? But I would say, the surprise number one would be just a sheer fragmentation of data sources, right? You have pricing, you have ownership, you have transaction level data, and this lives across multiple chains. It lives across multiple custodians, across multiple trading venues, and there's no unified schema, right? And so to some respects, depending on, kind of how well-versed you are in data, it could be, like taking a drink from a fire hose, right? This is probably a good way to describe it. And so I think that's generally been a bit of a hurdle, for customers as they started to kind of get involved. The second would be what you're actually buying, particularly in tokenization, right? And so, I can use like an example of, are you buying a tracker certificate where your risk is actually in a debt instrument against the tokenizer, right? Even if they are one-to-one custodian, like if that custodian fails or if that entity fails, like where does your risk lie, right? And so that's something has been a little bit eye-opening for people that, as they're learning more and more about tokenization and how that actually occurs. As I mentioned before, kind of like multiple sources. And so this also creates hurdles around reconciliation processes, right? And so what's your single source of truth, right? You got tokenized assets that require reconciliation, across multiple ledgers, right? In some cases, near real time, right? So you could be trading on centralized exchanges, decentralized exchanges, and you need to pull all that in to make sure that your risk is properly monitored.
Yeah.
AML KYC as well, as I mentioned before. Like I said, like a wallet can receive funds from anywhere, right? And so you need to continuously monitor the address levels that you're taking in funds from, right? And so that could expose you to sanctions. It could expose you to different levels and quality of who your counterparty is on the VASP side. So like risk soaring, right? And so these are kind of new around like continuous screening rather than, as mentioned before, kind of onboarding of a legal entity, right? And
Yeah.
so that's another surprise. And so, kind of to your earlier, I guess, question is, these hurdles exist, and I always mention, decentralization offers a lot of benefits, but one of those is not standardization, right? And so, Lukka has, quite a bit of work that we've done here in this, and in the way that we've positioned our company is to be that trusted data layer, right? And so normalizing, aggregating pricing, market data, reference data across chains, different venues, and then feeding it into our enterprise data management so you can actually see what your positions look like across a variety of different trading venues, right? And also layering in kind of the AML and KYC analytics that we have for customers. So, helping them meet these requirements.
Yeah. Dan, I'm old enough to remember before trading systems were not Windows or GUI based, and we had these green screen terminals. I want to talk a little bit as we expand what tokenization means for financial markets, because it's a much more, at least now, complicated integration exercise in my mind for financial services firms and other firms that get involved in tokenization. Is that an overestimate on my mind, on my part?
No, I mean it's real, right? And as I mentioned, as people kind of progress down this, and anybody that's been involved in large scale migrations, technical initiatives at banks, like there's always these pieces of things that you didn't think about, right? And you need to address kind of on the fly as you work through the project. And there's several of these that exist. Data formats and mismatch around files, right? So
Yeah.
the traditional financial security master, right, doesn't always have a one-to-one mapping, right, around an analog on-chain, right? And so, as I mentioned, kind of, instrument location and in a blockchain, even things like decimal place precision has traditionally caused some of the more legacy systems issues where decimal places don't go out as far as they're needed. Also, some of the business processing frequencies are like time mismatch between processes, right? And so you have this always on 24/7, 365, depending on the network, new blocks coming, very quickly. And so, kind of when you map that back to traditional financial infrastructure, these tend to operate more on like a business day cycle, end of day processes and overnight batches. So, that's something around kind of the velocity and frequency of processes is something that, customers are looking at as well.
Yeah.
I also underestimated a piece here I do want to mention is the data provenance and trust, right? And so like I actually underestimated this as well. And so at Lukka, we run all of our own nodes, right? And they're all within kind of a SOC 1, SOC 1, SOC 2 type 2 frameworks. And I completely underestimated how important this was. And of course, SOCs are important, but running your own nodes and understanding that you didn't get it from a third party who then may have licensed part of that data set from other third parties. I had completely underestimated that. And so kind of the data provenance is starting to show up a little bit more in our conversations.
Dan, I appreciate that. And it makes me want to peel back a little bit of the layers on that. And for the record, you're one of the few people I've spoken to in our industry, Dan, that's actually used the phrase security master. And I haven't heard that since my days back on Wall Street. But it does make me think about data standards. And, when you look at financial markets, data standards, as you and I know them now, took decades What happens in a tokenization world where there are multiple standards that need to be adhered to? What kind of, I don't want to call it a reconciliation exercise, but there is an interoperability concern there. You reference aggregating that data, you reference bringing in that data. How do you sip from that fire hose?
Yeah, I mean, it's again, it's to my comment about, defining the benefits and standardization not being one of them. And, there's initiatives and Luca's done a lot of this with our customers, to help normalize that kind of data layer, so they don't have to worry about it, right? It saves them quite a bit of time. But as I mentioned, the asset identifiers, understanding kind of where, not only what you bought, but kind of where it resides as well, right? And so this concept of identification now actually needing to, handle the blockchain that the asset resides on. This is important. Um, Inconsistent taxonomies. Is a stable coin? What does a stable coin look like? Some people lump that in with a real world asset, or tokenized, real world asset. Should it be, what is a wrapped asset? And so there's things here, that are newer to digital assets, right? That security masters do need to take into account, as I mentioned, kind of also the legal structure in what you're buying. And so Luca's approach to this, and we've been around now for 12 years as a company, right? And so we spend a lot of time, normalizing data sets for our customers and our products to work. And in a lot of cases, we eat our own cooking, right? Our products don't operate without that normalized data layer, right? As I mentioned earlier. So, we have built out a lot of standard taxonomies that we use in our products, as well as our services. So that's, the way that we've approached it.
Yeah. Dan, I want to continue to peel back the layers of the onion a little bit here when you talk about data standards. And I know you have a graphic you might want to show a bit later on. We'll make it available to attendees later also. But it struck me in the early days. You guys have been around for a long time. There's no QSIP particularly related to a lot of the stuff that we're talking about, correct?
I mean, there are ISINs that are issued, right, and then there are kind of token level identifiers, through ISO that you can get, and that they're helpful, when required for reporting requirements, and they do sit kind of within that ISO framework, and the QSIP and ISIN are a known entity in identifications. But you can't always 100% rely on it. So
Right.
what I mean by that is, if you need an identifier and it's not there, like, what do you do, right? And so you almost need somewhat of a waterfall, if you will, right, and to ensure that when you need to assign an identifier to a digital asset, that you can, because everything downstream in your systems won't work if you can't identify the instrument that the system is referencing, right? And so, again, early stage, but people aren't waiting for like the standards to be evolving, right? That they're building now, so they're thinking about these things.
Dan, as you describe that as well, I often think about when we talk about tokenization writ large across markets, you really do also face this on-chain, off-chain sort of dichotomy and that kind of interoperability. How do you deal with that particularly? And I think of it in context of PII, personally identifiable information, and the information that firms capture as part of having these customers, but don't want exposed on chain, for example. How do you envision that developing over time, and how are you all handling that currently?
Yeah, I mean, so there are blockchains that are private, right? Like Canton Network comes to mind as probably the most popular example, at least within the traditional finance community, right? But indeed, there are ways that you don't have to allow certain information on the blockchain, and as mentioned before, sometimes there's on-chain, off-chain processes, right, around with some of the tokenized funds, for instance, they have their whitelist that's managed off-chain, right? And so when they're looking at the gate of where they can transfer a tokenized fund to, that's usually handled off chain on a whitelist, right? And so does that become more automated over time? Likely, right? But there are ways that people can keep their information private, even being on a public blockchain, right? So but it is. I mean, if you think about kind of this on-chain and off-chain reconciliation, it's something that really needs to be thought about, right? Because your compliance, your financial reporting, your risks, right? Like, if these things don't tie out, you could have some potential issues with regulators, maybe your auditors, right? Could have some issues. So you really need to make sure, these things are buttoned up.
Yeah, and to that point, I want to build on that a little bit when you talk about like the whitelist, and those are things, many people at institutions have known for a long, long time. I'm struck by the throughput of tokenized transactions and crypto assets and digital assets. You've got to imagine there's going to be a pretty heavy overlay of managing whitelists or wallet addresses, for example, or other PII. I don't want to make this an AI conversation, but there's got to be some kind of bolt on with AI managing whitelists, no?
Um,
I had to throw that curveball out, Dan. I'm
Yeah,
sorry.
no. It's a good question. I don't think it's necessarily an AI question. I think what you're kind of getting at the heart of this is just more of, scalability, right?
Yep.
And sharing whitelists and through emails and spreadsheets is, just something that won't scale, right? And as you get
Yep.
more and more funds and more instruments on the rails, we have. For instance, a lot of the banks will use Lukka for our vast product, where we provide a lot of due diligence on their counterparties, right? And so, as part of that data set, we do a lot of wallet attribution and wallet tagging that customers have found very useful, not only for compliance, but like to understand who they're dealing with, right? And
Yep.
so, you definitely will need a solution longer term to scale.
You didn't mention faxes from back in the day, Dan. So I admire you for not going that far back, but that's stuff you and I had to deal with back in the day as
Yeah.
well.
I traditionally come from the bank loan market, so it's a small niche part of the over the counter credit markets. And yeah, I mean faxes I've been away from that for 5-6 years now, but at least during my time, faxes were a thing.
Syndicated loans, buddy. Pages and pages of faxes.
Yeah.
Dan, let's move on. There's still a lot to cover. I would argue, and I wanted your input on this, and I'd love to hear how you're all handling it. Ownership is a different thing in a tokenized environment. And how do institutions think about the difference between holding a token and actually owning the underlying? And the parallel in financial markets that we've seen, particularly lately, is Dan can buy an SPV of something that owns a share of a private company, but you don't
Yeah.
actually own the share of a private company. What's that parallel for tokenization, and what do institutions need to be focused on?
I mean, at the end of the day, the institutions need to underwrite the legal structure and the transaction history, right? And so, what do they actually have claim to, and how clean is that history, right? And again, if you're coming from the traditional financial market space, right, the AML and KYC and interacting with sanctioned wallets or anything like that, is a very serious issue, right? And so, like as you mentioned, we've seen, a variety of different tokenization types, and it's a field that we track in our security master data set. Is we've seen everything from you're making a loan to an SBP, right? And the way that you can get paid back is if they monetize the equity that they've claimed to have, right? And like that was one view. There's some that you actually have actual custodian receipts, like one to one, right? I think Paxos Gold, I think, is an example of something like that, where you
Yep.
actually have the receipts to the gold that's sitting in the vault. And then there's also very common where you're essentially kind of a debt claim against the tokenization, right? And then they may have the tokens in actually not the tokens, the actual underlying shares custodied one to one, but your risk actually sits against the tokenizer through a debt instrument.
Yep.
And so even the SEC actually came out with guidance. I think it was earlier this year around kind of like third party tokenizations versus like issuer sponsored tokenizations.
Yep. Well, the SEC just came out with a regulation crypto assets, which I have to digest after this webinar,
Yes.
Dan. So there's a lot going on. I think part and parcel of what you're discussing here, and when we talk about ownership, one of the core downstream functions of understanding that ownership is valuation. And when you look
Yeah.
at tokenization, I'm just looking at some of my notes. When you look at multiple venues, there's no, I'm going to throw out the phrase, there's no best execution, for example, in the world that we're seeing, right? There's multiple networks, multiple venues, multiple pricing models. How important is pricing and valuation? And how are you seeing institutions dealing with it? How does Lukka deal with it?
Yeah, I mean, it reminds me like the rails are new, but the assets and the obligations to those aren't new. right? And so like when you're thinking about, as you mentioned, like the fragmentation of this, is whether we're right or wrong, I think like time will tell, but we think there's a future world where you can really trade anything with anybody really at any time, right? And so um, liquidity can be fragmented across centralized venues, decentralized venues, could go through OTC desks, right? And so you need an aggregation methodology, right, to provide that kind of single feed, right? But what really is important is that the transparency in the methodology really matters. Like customers need to understand, like, how was the price constructed? Like what venues did you use? Like what kind of weights did you apply to those? What kind of your data cleaning are you using, right? Because if we're being open here, that's like not all exchanges are created equal, right? They have like varying levels of AML, KYC, kind of hygiene around like the price formation process and
Mm.
anti-manipulative behaviors. And so these aren't always equal across every single exchange, across every single jurisdiction, right? And so actually kind of thinking through that and selecting a principal market to be aligned to GAAP and IFRS accounting principles isn't as always straightforward as one would think, right? In a decentralized world. So at the end of the day, you need clean data with technology, but the confidence actually comes from consistency and transparency, right? And so that's what institutions need. And at the end of the day, they need to defend the valuation, both to their investors, but also to the auditors and regulators that they deal with.
Yeah, Dan, I appreciate it. And again, for everyone in the audience, thank you so much for joining us. If you've got questions for Dan and the team over at Lukka, please put them in the Q&A. We'll address them towards the end of the session. Dan, I'm going to rip up the script on you a little bit more. And I'm
No problem.
certain these are things you and the team have looked at, and so many of our colleagues in the WSBA membership and in the ecosystem look at as well. When you talk about those multiple venues, when you talk about multiple chains, and when you talk about that interoperability, there is a cybersecurity aspect to the conversations we all need to be fully aware of. Can you give me some of your thoughts on that? And we may not even have baked through that in the questions at all, but it comes up regularly in our conversations across the
Hmm.
ecosystem.
Yeah, I guess I mean cybersecurity. I mean this could be a rabbit hole that we go down and run, but and I think
True.
particularly particularly in the future, right, with computing power and quantum and what that will look like in the future. It's really hard to it's really hard to say, but what first comes to mind is your comment around custody and why people choose to self custody, right? Because they don't want a third party custodying their assets, and hacks and exploits are real, right, in this industry. So it's certainly a risk that needs to be paid attention to. um, but I don't know, like what are some of the concerns that you're hearing from maybe some of your
Well,
um,
I mean, yeah,
the,
it certainly is. Yeah, it certainly is. How do we have a cybersecurity program within the organization that accounts for new
oh,
venues
yeah.
that we've never connected with before? How
Mhm.
does our cybersecurity efforts scale in the wake of your Dan Husher brokerage firm that's begun tokenization across multiple platforms, for example, each one of them with different connectivity, each one of them with different
All right.
interoperability. So that's really where the core of the questions for many members are.
Yeah, I mean it's not an area that I'm an expert in by any means, right? I come from a data background, but if I'm going to guess, right, it's probably similar to your compliance function. Is you can't have this kind of separate compliance function that just handles the stuff like on chain in this like little
Yeah.
silo here. And I would suspect that your information security and your cybersecurity risk professionals at these institutions are evolving their risk teams. I mean, risk is so dynamic. I mean, if risk teams aren't constantly like evolving to face new threats, right? It's kind of the core of what they do, right? And so I suspect that at these institutions that they're evolving, their teams' capabilities.
It's interesting, Dan, because as you mentioned that so much of the cybersecurity conversation is really now across every vertical within the organizations that we speak with. So it's not just a kick it over to the compliance people. It's the tech team, it's the marketing team, it is everything that we know in some way touches cybersecurity. I don't mean to go too far afield, but when we talk about tokenization, we're talking about global market of trillions and trillions of dollars, and there's
Mm.
real concern about cybersecurity. Dan, we've still got a few questions left, and we are getting some comments and questions. Thank you so much to folks in the audience. You can imagine institutions being concerned about parallel books and records. I remember, and I'm sure you remember back in the day, I had more than one manager in the early days of my career saying, well, who's got the golden record of this transaction? How is Lukka handling or advising clients on parallel books and records and the challenges there?
Yeah, well, I mean, it's good we're getting some questions. So like now I know I'm not putting people to sleep. Right?
No,
with
this is
some of
important stuff.
my answers are good that they're having some questions. And so, yeah, I mean, you reference kind of the security master not hearing it for, however long. But I mean, if you think about anything kind of pre-trade, post-trade, like what the security master means for not only kind of the people that are trading, but like the ancillary service providers as well, like even index providers, right? You need reference data to like understand inclusion and exclusion criteria and kind of generate kind of, index criteria. But as I mentioned before, like it really becomes kind of the heart. And if you don't have this nice clean record, like what do you hang trades off of? Like what do you hang like risk reporting off of? Like what do you hang compliance records off of? Right. And so like these are actually instruments that contain value that are being transacted by an institution. So in a lot of ways, I view kind of that security master as like core, like a core theme that's like everything downstream is fed from. So like if you don't get that right, if I could use the cliche, it's way overused, but I'll use it anyway. It's the garbage in, garbage out, right? So
It
unless you have
works.
that, everything else downstream is going to be called into question. Right?
Yeah.
So
Dan, so as you dive into that, you're sort of very deeply alluding to controls and governance frameworks, which I think are critical to that conversation. What do those control and governance frameworks need to look like? And again, I say that in the context of there are institutions, when we look at some of the biggest institutions in asset management, for example, they're pretty deep in this space, right? They've been involved, they're issuing tokens, they're tokenizing a whole bunch of stuff. There are thousands of institutions that will be getting involved over the coming years. What does control and governance look like for them?
yeah, I mean, there's a lot of dimensions here. I mean, governance. I would start with clear ownership, right? And so like, who validates, any of your kind of on-chain data quality, right? Who are you getting it from? Probably part of that is your vendor management team and doing your due diligence on your providers. Like, who's approving that you can actually trade into new assets and how are they getting onboarded into systems, right? Like, who owns that? And then also agreeing to the taxonomy and classification frameworks, right? Like, it may sound like not a big deal, but like if systems don't define the terms the same, they can mean the same field can mean different things to different fields, and you almost kind of be fighting over this field, and that obviously will create a lot of downstream, issues. Also, from like a technical governance perspective, like understand some of the volumes that you're going to be trading at, like where you're going to be trading, what chains you're going to be trading on, right? And so, you got to really make sure that you're set up technically, right, to handle that scale. So, like, I'd get ahead of that, like before you guys start to trade at volumes. Because if you do it the other way around, I mean, you're not going to be able to scale.
Yeah. Dan, on that point, when we look back at global markets, I'll call it over the past 50 years or so, there had been a push in classical markets to standardize, to have some taxonomy. And in many instances, industry participants, and it took decades, came together to create some of those reporting standards, some of that taxonomy. I'm thinking swaps and derivatives, Dan. I'm thinking, broadly fixed protocol again for equities, for example. Are we going to need that level of, I don't want to use the word consortia, but that level of engagement from industry participants? Or are we going to need to look at regulatory kind of input on what taxonomy should look like for the industry?
Yeah, I mean, they'll evolve over time, right? And probably that will be driven a lot by obviously the ecosystem participants, and there's parallels in traditional markets, as you mentioned, kind of over the last 50 years, whatever the case may be, right? There's generally accepted sector classification taxonomies. There's generally accepted identifier providers. there's certain kind of technical languages that people adhere to, right, and can build technically too. So, no doubt that the ecosystem will continue to build into this stuff. Um, there are obviously a lot of benefits for having like third-party providers, as I mentioned, kind of index providers and independent valuation providers and auditors and things of this nature that will help drive that. But the more standardized things come, I've been working in data for 20 years, and like every time you get new data, that it never just matches, it never just lines up, it's never clean, right? And just you spend 80% of your time actually just pairing and wrangling data, right? And like 20% of that time actually working with it, right? And so the more that we can kind of continue to push down standards and just operational efficiencies to be gained for systems downstream.
Dan, to that point, it is still amazing to me after all of these years how unstructured some structured data can seem to be.
Yeah, it's never clean, right?
Never
But
clean data.
that's the reason why we have a lot of the products that we do, right? And so
Yep.
um, we can alleviate some of those headaches for customers.
Yeah. Dan, you the other day in prep for this, you sent me over some graphics that really spoke to event flow when you talked about some of the data. I'll be honest, when I first looked at those, my head sort of exploded because I did not quite realize how much is there. If you're amenable, did you want to maybe share one of those and step through
Yeah,
what the event flow might look like?
yeah. Let me see if I can bring it up here. Let's see.
If sharing should work, unless the
Okay,
team
let me
or the
just
team's
bring this
getting too
up.
mic.
Share. Fingers crossed. Let's see if it works. You should see maybe.
That's your backyard somewhere? Where is that?
No, see, so I share it and then the screen goes away. Give me 1 second. The file that I have up. Bear with me here.
Yeah, no worries.
I'll bring it back here.
I would tell the audience knock knock jokes while you're doing this, Dan, but
All right.
oh, here
Um,
we go. That's the
yeah, I do.
picture.
I live in Florida, right? And so it's not too bad down here. Like I said, I was in New York for a long period of my career, but
Yep.
definitely doesn't look like my backdrop. But yeah, can you guys see my screen?
We can see, and you've got NVIDIA Corporation up there. Dan, this is one of the graphics you shared with me, and there's a lot there. It might be a little hard for some folks to read. We'll try to get a copy out to attendees, Dan, with your permission. But can you step through what this is representing? Because it struck me that it really is the integration of traditional and non-traditional rails and how the data is represented.
Yeah, and so we put this together, and this is one of the first infographics. We just published a white paper on how security masters kind of need to evolve the data model themselves. The data fabric needs to evolve with tokenization, and this is kind of the world as kind of we see it. And we did an example of NVIDIA, and so you can kind of see here. I don't know if can you confirm? Do you see my
I
mouse
see your, I see your cursor moving.
as I move? Okay. And so, this orange box is what has been working in financial markets for, 40 or 50 years, right? And so this isn't probably new to anybody on the call. So, LEI, that will be the legal entity identifier. That's what's used, primarily to identify, what legal entity they're talking about. And of course, you have your AML, KYC, and compliance, and who you're doing business with, and incorporation documents at a bank, and you can kind of look through that legal entity. But here you have your traditional capital stack, right? And so you have, NVIDIA bonds and NVIDIA equity, and these will have derivatives traded on it, and so you can link, listed options. You can go to single name futures on NVIDIA. You can trade. You can probably approach any bank and enter into a total return swap, or buy credit protection from a bank. And traditional market data comes from, depending on where you're trading, could come from an exchange. It could come from an electronic trading venue. Could come from a Bloomberg chat, right? Depending on where you're trading and your trace feeds. And the point that I'm getting here is all of this data is already connected via QSIPs or ISINs, and this has been working, as I mentioned, for decades. And so as finance moves on tokenized rails, there's this kind of new new area that people are really looking at. And we've had a couple conversations with issuers through some of our partners, like, oh, like I didn't even know my equity was like being traded in some of this fashion.
Yeah.
And so you start to kind of move into the tokenized world, and we created kind of these plugs to make the connection. As I mentioned, I've been in data for 20 years. So I'm pretty passionate about like making sure kind of data fits together nicely, because I've had a lot of frustrations working with data, and you couldn't get quite to the
I
end
can't
result.
imagine.
They didn't match, right? And so I was like, well, when I build products, I'm gonna build them to a certain standard. And so here's an example of you have your traditional common equity, right, for NVIDIA. And so now you have tokenized versions of NVIDIA, right? And you have Ondo, you have R stocks, X stocks, right? Robinhood, right? And so these are just a handful. It's not meant to be comprehensive. Obviously they have more bonds outstanding. There's more tokenization, but it's just meant to fit on the screen. So you have these tokenized versions, right? But as I mentioned before, location matters, right? And so each one of these tokenized could be on 1, 9, even 10, maybe even more blockchains, right? And so now you have this kind of this address on a blockchain, and so now you can actually then plug in kind of your on-chain data, right? And so who's trading what, who holds what, how much do they have, what wallets do they transact with? And so this is where kind of Lukka's off-chain data comes in with the wallet attributions and understanding. So you can understand what's happening on chain, what chain that's happening on. In our reference data and security master, we link to the blockchain in the address, but then we also link back to the traditional identifiers, right? And so we have a CUSIP license and an ISIN feed. And so we provide those back to customers. So now you can kind of see all this on-chain data flow right back into your traditional identifiers. But furthermore, there's not just the tokenization of those, this non-traditional derivatives now. So like perpetual futures, right, is an example of something that is relatively new in derivatives, right? And so you have perpetuals traded on the tokenized stocks, right? And so in our derivatives reference data, that links back to the Lukka ID, that then links back underlying through the ISIN. And then we have prediction markets as well, which we have data on as well. And so this is a fascinating product, probably worth a webinar, in and of itself. But this is.
I was going to say, Dan, when I saw you add perpetual futures and prediction markets to this slide, that's webinar
so
number 2.
I said something, we're in the first inning in prediction markets, and one of the trading venues that we're working with is like, I agree we're early. I would say we're still in spring training, right? As opposed to the first inning for those that baseball reference. But and then just finally down here, we have now traditional data moving on chain. And so you have the PIS of the world, you have chain links, and I'm sure there's many other oracles, right? But you see FX data, you see metals data, commodities, equities, rates. You even see pre-IPO, like the Tesla IPO. Like this was trading, in decentralized exchanges, well before, SpaceX was priced. So really cool information now being published on chain. But again, the same issues exist. Oracles are different, right? And so like, how do you map all of this stuff together? So kind of this blue kind of outline, if you will, or borders is kind of where Lukka helps normalize and map back to the orange buckets that traditional institutions are used to.
So. Dan, as I'm looking at this slide, and you talked about traditional rails versus non-traditional rails, and critically important, all of this data, it does make me ask the question, if we can go into a bit more detail. You certainly talk about mapping to the non-traditional securities, non-traditional kind of assets. What happens the other way, Dan? And I'm curious about, for those who know global financial markets, I'm thinking about when issued stocks, corporate actions, splits. I'm thinking about all of the niggling things that can happen to securities. Is it difficult to disseminate that out to the non-traditional rails for you guys?
It is difficult. And so again, it comes back to my comment, like the decentralization and the benefits, but also no standardization, right? And so we get this question a lot when we demo our crypto actions product, which is corporate actions, but for digital assets. Okay. Like, oh, this is great. I understand it. I understand corporate actions. So they can immediately like make the jump into digital assets and what that means. Of course, there's things that are a little bit novel, like a contract migration or an address migration. forks that don't necessarily have a one-to-one mapping to corporate actions, but they always ask like, oh great, where are you getting this data from? Like, you got a feed that you take in, and then you just and it's like, they're like, we are this this central kind of mechanism that you take this. We connect to over 500 venues, right? And we normalize assets, we normalize ticker pairs, we normalize blockchains and all of the blockchain data into kind of normalized feeds for our customers, so they only have to build one pipe. And so again, like, we're going out there, we're harvesting the information. It could be, it could come from a variety of different sources, different flavors and different colors, and we are that normalization layer. And we do become that kind of centralized feed to customers, so they can keep their security masters up to date.
Dan, I really appreciate this great graphic. I want to build on something we talked about a bit earlier. When we talk about the growing tide of tokenization, and we've talked about a bunch of different firms and a bunch of different types, all of these firms, large or small, have things you've mentioned: accounting and custody and reporting and risk management, and kind of the litany of systems that they've had to make significant investment in. One of the pushbacks I've heard is, well, I can't really get involved in this, Ron and Dan, because it'll just blow up all my existing workflows. And I see the point. I'm not sure that's necessarily fully the case. What's your advice to those firms?
Yeah, I mean, you're gonna have to address it, right? And so, like, your organization will make a decision. Are we going to be involved in the tokenization of assets and finance on chain, right? And if the answer is yes, it's the decision's kind of made for you, right? Like, it's clear, like the arrow only points one way at that point, right? Is you need to start to evolve the systems. So you can operate in it, right? And so, the risks of not doing something like that is, like I said, you have systems breaks, you have a bunch of manual workarounds, things are managed in spreadsheets, you can't scale, right? It induces a ton of risk into the organization, right? Because now you may not have lines of sight, into where your risk lies, right? And that creates a whole other kind of, vector for an organization to manage. But we do kind of position as, it can get complex, but like, take some solace in, like, there are providers in the space, Lukka being one of many, right? That only service institutions. They don't service retail, and they understand the people that work at these institutions have sat in the same seats that the audience is in, and we understand what it means to service what, in my opinion, is probably one of the most demanding use cases in financial markets, right? Is financial market participants. And so we've thought a lot about this, and there's other people in the industry that's thought about this. Like, you definitely don't have to kind of go through this journey on your own. Like, use us as a resource, reach out. Like, we work with our customers. We'd like to think of ourselves as a partner rather than just a vendor. We've thought a lot about this, and a lot of our products are on their second, third, even fourth iterations. And when you're assessing the vendors, whether it's Lukka or not, like, just pick your vendor. It's like, have they demonstrated the capability to keep pace in what is arguably one of the quickest evolving ecosystems? And can they keep pace and kind of not only match what you need from them today, but are they also going to be there in day 2, day 3, year 1, year 5, so on and so forth? So they need to continue to evolve.
Yeah, Dan, completely agree with you, and you're absolutely right. To me, it's almost a strategic conversation, because your workflows need to evolve, and you're not in it alone. There are providers in the space, certainly like Lukka. It's an ecosystem worth pursuing from a long-term strategy perspective. Dan, last question that you, pardon me, you and I discussed, looking ahead. We're moving well past pilot projects to broader institutional adoption. What capabilities should firms be investing in today? What should they be looking at? And again, let's use the example: Dan Corp is going to be tokenizing their shares, for example, or want to offer tokenization to their clients. Where does that investment in their future need to happen?
Yeah, I mean, I think you just touched on it, right? Is the systems need to evolve, and as I said, at the top of the hour when we started, like, being pragmatic. It's like, the rip and replace, like, it's not happening, right? Like, this stuff is too ingrained. It's been there for 20, 30, 40 years. Even the people that are operating the systems may not fully understand it. And so you definitely have to understand kind of the systems need to evolve. you need to be pragmatic about it. They're going to need to talk to each other, right? AML and KYC is something that's top of mind for every customer that we're talking to, right? And so this concept of I'm going to be able to take in, digital assets from a wallet, but like I got to understand what was in the wallet. Where had those funds been, right? Did they go through a mixer? Did they touch a sanction address? Like these are all kind of new areas that they need to be thinking about. And AML and KYC is probably at the top of the list. When we're chatting with our customers and assessing the risk, which I think is good.
Yeah.
Also thinking about how you bridge the traditional rails with the blockchain. And we spoke a lot about data and kind of how that needs to be normalized and understood downstream. And, the more, at least from my historical experience, the more time that you spend on the data architecture, the data model, if you can get that right, it makes so much downstream things easier, right? And less risky, quite frankly.
Yeah, rework is always more intensive and more expensive, Dan. Dan, we're coming up on time in a moment or two. I want to end off with one thing for you, and then we have a couple of questions we certainly need to address. You recently published a paper. I'll be honest with you, pretty deep stuff called Compatible by Design. I suggest it for anyone in the audience. I think you posted it on LinkedIn. It's on the public site as well. Dan, tell us what drove you to write as complicated a paper as it seems to be.
I think part of it's probably I'm just kind of nerdy when it comes to data. So like I started working in data in 2005, and so it was fintech before. I think actually fintech was a category. At least I wasn't hearing it at the time, and started to work with data and just kind of enjoyed it. And this was at a time before data was sexy, quite frankly, right? But I just I enjoyed it, and I see the world moving in a new direction. It's one of the reasons why I chose to start to get involved in digital assets, and I could use my data background and my financial markets, financial services background also help shape where I thought the future was going, right? And making a career decision, I kept asking myself, why doesn't this work? And I couldn't come up with a good reason, right? And so like I knew I wanted to kind of move into digital assets, and I've been doing this my entire career. So it's thought it would be very helpful for the industry to kind of think, hey, we've thought about a lot about this. We've been deep into this, specifically in data and reference data for 6-7 years now, and it could be helpful, right? Quite frankly, so.
No, Dan, it's definitely for everyone in the audience, definitely worth the read. We'll be sharing it with our WSBA members. We've worked to amplify it publicly. Dan, I want to thank you for making me feel even older because data management when I started on Wall Street was get those little floor reports off the floor at the New York Stock Exchange, put them in a box and bring them to the office. So appreciate it, Dan. Totally kidding, but we've got some questions to address from the audience. Again, everyone, thank you so much. Someone posted anonymous, Dan, sorry. How much confidence score is there in Lukka's data? How is the data aggregated? And how do you tackle anomalies if found in the data? So that's a granular kind of follow on to the question already addressed.
Yeah, I mean, it's a pretty broad, it's a pretty broad question, but I guess let me use it by examples. And if I don't answer the question, whoever, if it was anonymous, if you want to reach out to Ron and set some time up with us, we're happy to walk through it. But it starts to you need to understand kind of the underlying data. So I'll give you an example on Lukka Prime. Lukka Prime is Lukka's pricing algorithm, and so we created Lukka Prime because auditors were dinging their customers. They were dinging their customers because they weren't performing the principal market analysis, right? And so that's prescribed to by GAAP and IFRS accounting principles. Now, in a customer's own defense, there wasn't really a good solution out there, right? And so we built Lukka Prime to actually assess the quality of the exchanges, the volumes of the exchanges. And so it kind of this gets to like, how do you aggregate it, right? Is one, you got to have connectivity and pull in quite a bit of data. And then you also need to express views on like the quality of those exchanges. But then you need to have that scale, right? And so technology needs to be involved. So like when you produce a price, it needs to be replicable, right? It needs to be transparent and it needs to be reproducible, right? And so generally, if you can obtain those, like customers get, very comfortable. And this is a product now that's on its seventh year. It's gone through several bouts of volatility and changes in digital assets, and continues to perform pretty well. But when it comes down to how do you aggregate the data, it's gaining access to the data, right? And so building out the connectivity, as I mentioned, you have connectivity to over 500 entities. Could be custodians, it could be exchanges, could be blockchains. And as I also mentioned, we also run our own nodes as well. And so we're able to go, as low level as needed into the smart contracts, where we need to extract that type of information. So again, kind of a broad question, but like, I hope I got to the heart of it. But if I didn't, happy to have a more in-depth conversation.
Yeah, and then to that point, when we talk about anomalies in data, I don't want to keep scheduling you for webinars. That's an entire deep dive for a couple of hours
It is.
as you and I
Yeah.
look at data sets.
Yeah. I mean, I guess one more thing is, I don't subscribe to a belief that there is bad data, because even bad data, knowing that it's bad, is informative to other parts of the system that's assessing data, right?
Yeah.
Particularly in algorithms and in data quality controls, outlier detection. And there's even instances like, even quote unquote, your traditional outliers could
Mm.
actually be the right data point. And I've seen many of these in my career. And so, kind of your standard deviation tests, aren't always best placed to assess that, because you have to ask yourself, where's the price formation forming? And
Yep.
that's likely kind of the tip of the spear in where you want to focus your efforts.
Yeah, even outlier data has something to teach us. Dan, absolutely agree with you. I think this is our last question of the session. How, and I'm going to try to see if I understand this, Dan, how should the taxonomy for data providers who are handling multiple asset classes, what should they be focused on? Is it risk score? Is it anything else besides risk score? I guess it's a good question because, like, when you're looking at multiple asset
Mhm.
classes, how do you validate them across the ecosystem?
Yeah, risk scores.
Let's look at risk scores. Let's start there.
Yeah, I mean, there's credit ratings in the traditional world, right? There's buy sells, right? I guess in equities, but what comes to mind, particularly in digital asset, is the risk score and the level of confidence that you have around that wallet, what that wallet has done, what it's held, the funds that it's transacted in, like where has that been upstream? And this is more of like a philosophical like question, but like, if I went to the grocery store and I bought milk, and I guess I'm probably dating myself again if I used money, cash, right? And I bought milk with $20 and I got money back. And then whatever was sitting in that cashier's drawer, like, I don't know where that dollar has been, but I can go and then I can, deposit it in the bank, right? Or I can go to, the gas station and buy some gas or something like that. But it is a little bit different, like right or wrong, like digital assets are held to a different standard, right? And it really actually matters if you've taken funds upstream from some type of tainted wallet. So like risk scoring around the wallets is probably the most important. Um, we do produce scores on the assets. The biggest consumer of those are listing departments and exchanges. Due
Mm.
diligence, like they have to perform due diligence on the entities that they're doing business with and on the assets that they're listing. Right. And this is not just listed, but compliance departments on, hey, do I even want my team trading privacy coins? Right. For instance. Right. And so that comes back to our security master and pre-trade compliance. And so we have a multi kind of dimensional scoring framework for um, fungible tokens and also stable coins as well, that quite frankly would take days, if not a week, to wrangle all that data and map it together. But we've saved them time and we've done that for them. Again, we don't express a view on whether it's a buy or sell, whether it's good or bad, but we provide all of the underlying information that the end user can use to assess it.
Dan, we're just about out of time. Thank you so much. There's so much there for everyone who joined us. Really appreciate your time. If you've got additional questions for Dan, please email us info@wsba.co. We will get you connected. Dan, where do people learn more about you? Where do people learn more about Lukka?
Yeah, come to Lukka.tech, hit the contact us button. And I don't know if my email is available to the members around, but feel free to share the graphic, my contact information. Again, like even if it's just whether you're an OG or you're just new to crypto, like or digital assets, and you want to learn, like give us a call. Like we're happy to sit down, and we have dozens of people that have been in traditional finance, very close to blockchain, audit backgrounds, like you name it, deep into blockchain engineering. It's probably likely that we have an expert in house that can walk you through this.
Dan, thank you so much. We're going to leave it there for everyone in the audience. Again, thank you so much for joining us. We'll get the recording out there as well. Have a great rest of the day. Dan, good seeing you, buddy.
Yeah, good to see you again. Thanks for having me again, Ron. Be good.
Got it. Bye-bye.